Welcome back to America's Commercial Real Estate Show. I am Michael Bull, and this segment is brought to you by Real Crowd. It is crowdfunding with the professionals. Check them out at realcrowd.com. Well, today we're talking about the economic outlook and the impact on real estate. My guest is KC Conway. He's a senior economist with CCIM Institute. He's here in Studio One. And KC, we're talking about and political things that could make a change in the economics and in turn in real estate. What else could be, let's first go with the negative things. What else could be a headwind in commercial real estate moving forward?
So I'll have to tell you, I got to have one prop, Michael. So, when I do my forecasting or whatnot, the reason I'm so accurate is the University of Alabama, when I joined them last year, they gave me these magic crimson red economic forecasting shoes. So these help. So I brought my magic shoes to help me today on the forecast there. So on what goes wrong, I've had three things that are primary. Most people, can deduce these pretty easily. So I think the tariffs and trade wars have been on our mind for a while, all through the summer, as it's kind of ratcheted up. So if they don't get resolved, we go back through the history of tariffs and trade wars. I mean, go back and trace the roots of the Great Depression that started with Smoot-Hawley and tariffs and trying to, protect agricultural industry that spilled over into the whole Great Depression. So history has told us these never play out well, and eventually kind of reverse course. So we are playing a little bit with fire. I do think, though, that having the agreement, the new NAFTA 2 or USMCA, we can play with the YMCA music, is a very good thing, because what it does is it brings North America back as a trading, manufacturing block with lots of commodities, lots of skill set, intellectual property. It is a real formidable threat to China. So I think that potentially brings China eventually around. I think China's going to be a year or longer to come around. I think it brings Europe around pretty quickly as well. So I think having that deal done really reduces what could go wrong on tariffs and trade wars. And I think the reason that people forget, it's not so much inflationary, it's supply chain today. So more about what we're getting a lesson on is how intricate supply chain is. So if you're in the building business, whether it's steel, whether you're a home builder, most of the faux granite and stuff that you get and put in bathrooms and whatnot, that all comes from China.
That's faux granite? I thought it was real.
Faux granite didn't come from Rome, Georgia, up the road here. So a lot of these products and things. Another one is all the batteries in cars. So there's a guy out there, a company called Cobalt 67, and he's working to kind of corner all of the future options on Cobalt 67, which is a primary element that's needed in all these electric batteries for cars and whatnot. So, if you don't have that element, in Canada and China have 80% of the world's supply of cobalt that we know of today. So it's about logistics, it's about supply chain, less about inflation than in prior times. The second thing is, I think, looking at the Fed and the liquidity of kind of financing. We know that commercial real estate functions very well when it's liquid, when there's financing, when there's debt. And we're in a comfort zone right now. It all works really good until it doesn't. So the Fed really needs to pay attention to what it's doing, because as it raises interest rates, it puts pressure on emerging markets, which are 40% of our economy. They're 40% of our consumers, because they've been on quantitative easing, and they've got to hold a certain amount of dollar-denominated assets, or the commodity is traded in dollars, like oil in agriculture. So if we're raising rates, their currency's devaluing, it takes more to buy our goods. So the Fed's really got to pay attention, and that spills over into really what I call the currency crisis risk. We saw it spark up with Italy over the summer. We saw it spread to Turkey, and it's a great risk of spilling into Argentina, Latin America, and Africa. So we're going to get a history lesson on currency crisis is what could go wrong. And I think the third thing is really the inflation story has been undertold, dismissed and swept under the carpet. We have it in housing, we have it in commodities, we have it in construction materials, and now exacerbated by the hurricane storms from last year and again this year. So I think the inflation number is very undertold and underemphasized, and I think that's what keeps the Fed with their foot on the accelerator to raise rates.
So is that going to cause them, it sounds like for what you're saying, that we should expect inflation to increase. I don't see anything stopping it at this point. So does that mean interest rates will keep rising?
Yeah, so good question. So this week was the anniversary of Paul Volcker's testimony to Congress in 1982, where he said, I think I overdid it. The Fed overdid it. The Fed always over and underdoes it. They're always late to start the rise and overdo it, and they're always late to reduce it and stop it. Just like in 2016, they started in 2004, and they went to mid-2006. And I did a briefing to Chairman Bernanke and said, you're part of this subprime mortgage crisis. 16 rate hikes is making people figure out, how do I refinance these mortgages? So I don't think the Fed has on pause. It's got the dual mandate. It's got full employment. And maybe more, and especially if we see the unemployment rates drop into the mid to low 3%, which I think we could see as early as this Friday's report, definitely by the end of the year. You have full employment. You now have wage inflation with, we saw it last year with Walmart and Target raising the minimum wage in many states. Now we see Amazon and others getting it up to an affordable wage rate. That trickles through on their construction inflation, housing inflation, whether it's apartments or rental. Inflation's systemic in the system now, and I think it's running well above 3, probably in a 3.5% range.
Okay, and as we're talking about things that could be possible headwinds to commercial real estate and real estate in general, so rising rates, is that one of the potential headwinds?
I think it absolutely is. And I think you have to understand the rising rates, where it ripple effects through. So for most of us, we haven't seen our credit card rates move at all. They're always high.
Right.
But we do on the things like mortgages, autos. So if you went to buy a car, so your finance rates on a 4 or 5 year mortgage on a car today are 75 basis points higher than they were a year ago with the same credit score. On a mortgage, on a home, you're 75 to 100 basis points higher right now. So what that translates to on a car payment, you're about $35 to $50 a month higher. On a home payment, you're about $100 to $150, approaching $200 depending on the price point. Now we're getting to real dollars where you're talking $300 to $400 of disposable after-tax income. That begins to eat up the impact of the tax cut.
Interesting. And you bring up the auto business. That's a big part of the U.S. economy, right? And if we have rising interest rates there and we have higher steel prices, does that impact our economy moving forward?
It certainly does. So, and the dynamic in the autos isn't just, the components that go in there, but it's also the technology. So one of the things I like, I have USA Insurance, great company, and I was talking with them recently about auto rates with my daughters, one of them having had another wreck, and I said, so, what cars are highest and lowest in insurance rates, and are you having the most problems with? And they kind of said, well, one of the ones that we're having the most problems with, and we don't think you can buy your daughter this one, is a Tesla vehicle. All these electronic cars, the batteries are underneath them. And so you go over a speed bump or hit a curb, you short the whole thing out. In many cases, the cost of repair is a complete total loss of the car. So the technology components, while the cars are safer, when you wreck them up, it's not like the old days of my 1967 Mustang. I go to the junkyard and buy a new bumper or straighten it out or a new fender for $50. Yeah. It's thousands of dollars to repair these cars. And the airbags alone are, going to be over another $1,000 to replace them.
Now it's going to be like a boat, break out another 1,000, right? I asked my insurance agent, what was the chance that my 16-year-old started driving and was going to have a wreck? The percentage, he said, 100%. I'm like, oh no. So those are some of the headwinds. What could go right? What could go positive for real estate and commercial real estate moving forward?
So what can go right? Real estate does really well when we have disruption, right? We don't want it when it's really capital driven, but when it's systemic. So technology is changing real estate in big ways, and it's creating things like adaptive reuse. We recently published a paper with CCIM Institute on that and how strong that is. Look at office. Look at the growth of WeWork. So WeWork now is the single largest office tenant in Atlanta, in New York. 5 of the other top 10 cities, it's in second or third place as the largest tenant. What does that mean, and how do we adapt to that? Does it make it better or make it worse? Is there more demand, less demand? Does it shift demand? Look at industrial. Industrial's the new retail. We don't go to stores to buy the goods. We put them in warehouses. So we're having this incredible growth in warehouses and supply chain. And we're a huge beneficiary of that in the Southeast and the Mid-Atlantic and the Gulf Coast regions from what's happening with our ports and supply chain. On housing, people may not realize it, but we actually have 2 subdivisions here in Atlanta right now that are being built, new subdivisions, where all the homes are for rent. They're not going to be sold. So we're going to see tremendous shifts in housing, where it's that 11-foot wide product for millennials. So tremendous opportunity for those that can kind of step back, study how the millennial workforce that's really maturing and now into its 30s is going to change the workforce in how they shop and how they spend, how we Uber everything, what it means for cars and parking garages. What are we going to do with parking garages? What do we do with a vacant mall? We're debating that with Gwinnett Place Mall right now that opened up when I was graduating from Emory University, and I still think of it as a new mall. We're seeing malls being converted to warehouse space. So there's just tremendous opportunity, and I would recommend people look and study hard at two elements. Look at the disruption that blockchain is going to do and permeate through everything in our economy. And what it means is, in real estate in our business, it means it can become much more efficient. It can eat away at some of these cost pressures that we're looking at. It means the elimination of intermediaries. We don't need all of these internal ledgers that we have to validate, like title companies and a bank to hold money and escrow agents. It's all a virtual single shared source ledger. Huge impact in terms of the cost and the efficiency of transacting real estate. That's a big benefit. And the second is how logistics ripple effects through everything. So, how are goods going to come to your house? What's that last mile mean? Is there an advantage being in one location versus another location for that last mile delivery? What about Uber and driverless transportation? So I think logistics and blockchain are the big disrupting opportunities that mean a lot for us.
Yeah. Well, I'd like to get your opinion on some of the various sectors and how you think the economy and everything going on in the world could impact those sectors moving forward. So we'll do that right after a break. I'm Michael Bull. Stay with us. This is America's Commercial Real Estate Show.